today as well. But I think we can turn our attention to the personal finance segment. Hemant Rustagi of Wiseinvest Advisors is our expert for the day. And the discussion today is that is it advisable for an investor to have a mix of both index funds as well as actively managed funds, or are they better suited only to a certain requirements or goals? And which one scores above the other? For, to answer all this, we've got Hemant joining us. Hemant, your comments.
Yeah, basically, I think firstly we need to understand both these kind of funds, what exactly they offer. Index fund is basically a passively managed fund because its aim is to track the performance of an index. Basically, it's benchmark index. Therefore, all the money that is collected in the fund is invested only in the stocks which are a part of this particular benchmark index. And the exposure to each of the stock depends on the weightage given to the stock in the index. The offer document of the index fund clearly states as to which index basically it is going to track. There are few advantages for investors who invest in index fund. One is that expenses are lower as compared to an actively managed fund. Second is investor at the time of investment as well as throughout the investment universe horizon knows exactly which kind of stocks are going to be there in the portfolio and in what proportion. The third is I think it's very easy to track the performance of a index fund because it's tracking a particular benchmark index. On the negative side, there are few here. One is that any investor who invests in the index fund forfeits his chances of getting better than market return because at best the fund is going to track index. The second is, an index fund is practically run by a computer. But in reality, what happens is there's a lot of price-sensitive information that keeps flowing into the market and which at times require the portfolio has to be aligned or modified, but which cannot be done in index fund. The third is an index fund has to contend with the tracking error. Now, what is a tracking error? Is basically a difference between the movement in the index vis-a-vis the movement in the NAV. And why it happens is because, one, there could be delay in deployment of funds on the negative side. On the positive side, the NAV of the index fund will take dividend into account where the index does not. On the other hand, if you look at an actively managed portfolio managed fund, in a true manner, an investor can benefit from the fund philosophy, its strategy, or the capability of the fund manager only in an actively managed fund. And the reason for that is because the fund manager has the freedom to move in and move out of stocks depending on the market condition, of course in conformity with its objective. The second is that there is a lot of variety of funds which are available in this space. I mean, there can be pure large cap fund, mid cap fund, thematic, sector. There are different kind of funds which are available. So if an investor truly wants to get the right level of diversification, he can do so by investing in different kind of funds. As far as the mix of these two funds is concerned, I think clearly it will depend on the kind of investor you are, what is your time horizon, what kind of risk profile you have. But as a thumb rule, I would say, a portfolio can be indexed to the extent of 10 to 15%. And what it means is that one can have exposure to the extent of 10 to 15% in index fund, and the rest should be in actively managed funds.
All right, Hemant, we'll come back to you with more questions from our viewers. There are some rules, for liberalized rules for foreigners participating in the NBFC sector. Now they can set up subsidiaries even with a slightly lower than 100% investment in their domestic units. Take a break. We are back with questions to Hemant. All right, we were discussing with Hemant Rustagi about whether you should put money in index funds or in non-index funds, that is funds where the fund managers have a lot of freedom. So here's a very appropriate question from one Jasmeet Dhingra from Ludhiana. We've not been able to connect to him, but we have his note. He asks whether we should change the fund if the fund manager changes. How important is the fund manager to the running of the fund? Therefore, instead of only tracking NAVs, should we also track news on fund manager movements? Hemant.
Well, I think the fund manager obviously is very, very important as far as the fund is concerned. But I think very important thing for investors to understand is, rather than actually following the investment style of a fund manager, it's very important to understand what is the investment style philosophy or the strategy the fund is going to follow, because that is what is going to help an investor in terms of building the portfolio. That is whether the fund is going to be following value investing or growth investing, what is going to be the strategy for stock picking, whether it's top down, bottom up, and all this information is available in the offer document. So it's very easy for an investor to really find out as to what kind of strategy and philosophy the fund is going to follow. So I think more than the fund manager style, it's important to look at the fund's philosophy. Well, as far as the decision to leave a fund or exit from a fund, after the fund manager leaves is concerned, I don't think it's wise to actually do it as soon as the fund manager leaves, because there are a few factors that an investor needs to look at. One is the kind of fund he is invested in. If it is a mid-cap fund where the stock picking is very, very important, it can make some difference in the short term. But if it happens to be a pure large-cap fund or an index fund or a debt fund, it may not actually make a difference. So first thing is look at the kind of fund you are invested in. Second is one has to look at how old the fund is, how long the fund has been in existence. If it's a relatively new fund, it may not actually make a difference. And also it's important for investors to understand that today most of the fund houses are following a concept of investment committee. Now this investment committee has a chief investment officer, the fund manager, and the chief executive officer as its member. Now if the new fund manager happens to be from within the fund itself, so the chances are he may be well versed with how the fund was being managed. So I don't think there is any reason for someone to panic and exit. And even if the earlier fund manager is replaced by someone from outside, what should do is to look at the track record of this new fund manager. And today there is so much transparency that the fund houses are required to publish the track record, or actually where the fund manager has been working. So it's very easy to see that what kind of performance he has given in the past. And if he ran some successful fund elsewhere, I don't see any reason why he will not be able to replicate the same success here. So my belief is that if the fund manager changes, one should give the new fund manager a period of at least 6 to 12 months, ideally maybe 12 months, to see what kind of performance he gives. And if after 12 months investor is not satisfied with the performance, maybe then the time is to move on.
All right, Hemant, thanks so much for joining us and addressing our viewer queries. And remember, viewers, to join us tomorrow.